start with some introductions. Let's start with you, Renata. All the microphones are on, and so you don't need to worry about them at all. Renata, let's start with you.
Hi, my name is Renata Ociecka. I'm a founder and managing partner of Aximo Group. We are, I would say, number one independent real estate broker and advisory firm in Poland. We have 6 offices. We do brokerage, valuation, property and asset management. I'm also past president of SAR Europe. SAR is a global organization of Society of Industrial and Office Realtors, which are the, I would say, top practitioners in real estate market.
Great, Carlos.
Hello, my name is Carlos Hadlis. I'm the executive director of international investments at WP Carey. WP Carey is a New York listed REIT. We focus on acquiring long-income properties that are mission critical to the tenant. Listed in New York, been around for almost 50 years. I am part of the European team responsible for covering the whole European region and here to do deals.
Perfect. Christina.
Hi, I'm Christina Forrest, fund manager for Pan-European Logistics Fund at CBRE Investment Management. CBRE Investment Management has got about 170 billion AUM in Europe, European fund manager, investment management house, and we have about 14 billion of logistics assets under management. So a really important sector for us in Europe, and looking forward to discussing a bit more about the sector today.
Great. Peter.
Hi, my name is Pieter Akkerman. I'm a co-head of Schroders Capital Real Estate in the Netherlands. We have an operational platform with about 2 billion of assets under management and a logistics industrial fund of about 800 million today. So that's
super. Joost.
Joost Leenertsen, Verisol. We are helping the logistic, making the ESG challenges in an opportunity.
Hi everyone, my name is Nick Cripps. I'm European Capital Markets Director at Panattoni and Head of Capital Markets for the UK. Panattoni are an industrial developer, 50 offices around the world spanning US, Canada, Europe and India. We've got 15 offices, 15 countries that we're operational out of in Europe, and pride ourselves on being the largest developer across Europe.
Great, thanks very much. And thank you to everybody joining us on the live stream. If you've got any questions, do add those in, and if you're watching it on demand, thank you. Let's pick up a little bit, and of course, if you've got any questions, just raise your hand or somehow indicate to me that you would like to ask a question, and we will make sure that that's put to the panel here, because we've got a super range of discussion points here. Let's maybe just pick up with you, Nick. Huge changes over the past 12 months, even 6 months, really. So I suppose, how do you see those, particularly looking at the sort of more global trends?
Well, I think 2022 is going to be a year that is a story of 2 halves, really. And I think entering the turn of the year, everything was looking like it was getting stronger, especially from an occupational standpoint. Coming halfway through the year, you sort of have now found ourselves in a very strange dichotomy where you've got the occupational market seemingly still very robust, and the markets with very sound fundamentals from a supply and demand perspective. But unfortunately, the capital markets has started to dry up a little bit, and we've now found ourselves with a new pricing environment, and with that we've got illiquidity in the capital markets and a bit of a standoff with a bid-ask spread amongst buyers and sellers. So. But the global trends that we've been seeing from an occupational point of view very much seem to be resonating still, if not actually accelerating in some capacity, and some markets around Europe.
And Christina, I saw you agreeing with that point about the trends. So maybe let's just pick up on some of those, the positive trends, I guess, that you're seeing in terms of the logistics sector.
Yeah, I think the big positive is the rental growth story that we're seeing, and that's clearly driven by the supply demand dynamics, which continue to be really positive. That is because there's really 2 big drivers of demand that we're seeing. It's the e-commerce story that is still there and continues, but there's also the supply chain reconfiguration, and that's probably the stronger, more medium-term driver that we're seeing coming through. Occupiers need to do more onshoring, be closer to the end customer, and that's really the big piece of demand, especially on the urban sort of areas. Urban fulfillment story is really strong. So I think it's really one, as Nick mentioned, there's two sides. The occupational story continues to be really, really strong, especially compared to other sectors. I think rental growth is not anywhere near as strong as in the logistics sector. But the capital market has been impacted by the current volatility that we're seeing. So really one of two sides.
Okay, good. And I suppose for you, Carolus, at WB Carey, what's your strategy in the sector? And I guess how do you see some of these larger trends playing either in that or creating challenges for it?
So I would definitely like the sector. We're keen to expand our exposure to the sector, but I think whatever the rule book existed until today, you have to throw it out of the window. I think the market has definitely changed, and you have to forget what you priced yesterday and open a new page today. That's one thing for sure. All you need to do is switch on the news and see what's happening on the capital markets, both on the equity side and on the debt side. So obviously, logistics sector is affected as well as every other real estate sector because of that. But on the other hand, as an investor, I think one thing we have to recalibrate to is not only the capital market things affecting the pricing, but also the occupational market. And while it's robust today, if you look at the wider economy and you make an assumption where you think the economy is heading, and you assume certain recession potentially hitting certain markets in Europe or globally, potential occupational market could be affected by that as well. And you have to then think outside of the box, what do you think the companies will do and how they will optimize their supply chain. And I think if you really want to find some trends in that, I think probably nearshoring is one of that. But I think that the one trend and the one asset class within the logistics sector that will see a massive increase in demand or continue to have demand will be probably the last mile logistics, the in-town logistics, the ones that make the delivery of the products more efficient. That's the one main trend I would see.
Okay, that's interesting. And Peter, from your perspective, obviously e-commerce has been a huge driver for a little while, but post-pandemic, the growth has slowed a little bit, as you would expect. So I suppose, what are you seeing as the key drivers? Is it that nearshoring? And I suppose, what are you also seeing? You're looking at logistics as a whole, but also what are you seeing in the Netherlands specifically?
Well, I mean, in the Netherlands, it's a very interesting market these days because it's a market that is driven by scarcity. Amongst others, next to the demand and all the trends that we have already mentioned, there is this big political discussion going on the contamination of landscape in the Netherlands due to all the logistics buildings that are out there. So there is an increasing trend to regulate the issue of land for logistics buildings, etc., which is driving obviously scarcity, etc. So that's an important element in the Netherlands. Furthermore, obviously, the redevelopment towards more carbon negative, net zero buildings, which is a trend in the Netherlands as well, because there's a huge emphasis on that from the government. So last mile, new developments, etc. There's an enormous opportunity there as well to create interesting new developments. Yeah.
Okay, good. Renata, I wanted to pick up with you a little bit, which will mean that that needs to come down here. Let's pick up with you what you're seeing, particularly in the CE region, and I guess what you're making of some of the trends and how they're playing out in your region.
I mean, for the last half a year, I would say the most surprising factor was rent increase, because for the decades, Polish market was very much in the favor of tenants. So the rent increase due to the inflation, the construction cost, and due to the fact that financing is more and more difficult and supply is not so, it's very much selective today. So the tenants had to face with the rent increase, which was welcomed not very easily, but I would say we can say that the market accepted somehow. We have additional factor. Obviously, we have the war on the border, which is on the CE zone border, and this made the whole atmosphere changed a little bit. So that's another negative factor, which let's say influenced investors to suspend the projects, to prolong them, and the transaction takes much longer time. Obviously, from the occupier markets, it's still a very strong market. We had the same demand as the last year, and we observed there are also a lot of activity on the southeast border from occupier side, who are preparing for the, let's say, better times, and also they are preparing for serving also Ukrainian market. So obviously it's not blunt. We cannot judge the situation as say that's positive or negative. It's so much fragmented. It's so much structure and complicated that it has never been before, but well, it's I would say one more probably factor are energy and heating costs, which will show and test the occupier markets within the next 3 months definitely.
I'm going to come to that in terms of energy, occupier markets in a second. I just wanted to pick up on the supply chains aspect. And there's a lot of discussion around what was nearshoring and is now being looked at as friendshoring, i.e. friendly states rather than potentially non-friendly states. A lot of discussion as well around obviously how much of that manufacturing is potentially going to come back from places like China, for example. So I just wanted to pick up, and anybody can take this, but how do we see that? Do we see that as an ongoing trend, and is that going to be driving significantly more demand for space in Europe, and potentially also maybe in CEE as well, Renata? You can start on the,
Yeah, I think we had a lot of hope for nearshoring because obviously Polish market is, let's say, less expensive, more competitive in terms of labor. So we saw a lot of, let's say, signals for that, but it's not so easy. The companies who are relocating from Asia, they have problems with supply chain of components. So it will be a longer process. What we see for the current situation is obviously the relocation of the companies from East, from Belarus, which was the let's say labor and production hub for CEE, and we also see a lot of Ukrainian companies and those who were producing or serving Russian markets, so they're relocating to Poland, and that's a trend. I can say it's not nearshoring, but it's kind of a, let's say, relocation.
And there's obviously been a long trend of globalization. Are we really seeing sort of de-globalization in terms of supply chains now? Is that where we think we are, that we're going to see a longer trend of that? Does anybody have a view on that? Nick, you can take that, yeah.
Well, I think that there is a lot of rhetoric, and I think, to be honest, that is probably the principal driver currently in Europe, and a lot of it's a bit of a lag from COVID times. It's reactionary, but it's less easy to turn on the light switch, so to speak. With e-com expansion, it was very much take a new warehouse, rack it, fill it, sell it online. Whereas, realigning supply chains, moving certain processes closer to home, building that resilience, inventory holding, that all takes time, and they're big strategic moves for these corporates. But what we're certainly seeing in the UK and resonating across a lot of the continent as well is very much businesses are looking through the short-term volatility. They're looking for building efficiencies for the future into their global supply chains. And a lot of this moving away from authoritarian states like Russia and obviously China +1 policies, that is, to be honest, what we're seeing the most tangible pocket of demand at the moment, which is giving us a lot of confidence because the corporates have made their decision. It's strategic. It's to do with their operational efficiencies and functionality of modern warehousing, which are a necessity if they're going to survive into the long term. So, there's obviously caution, and you've got to be rational. But I'm sensing that the occupational market is on a sounder footing, despite Carolus raising some extremely valid points around consumer spending and the impact that might have. And there's undoubtedly going to be a knock-on effect with consumers and what they're willing to spend online, and therefore the impact to the more omni-channel, e-com related occupiers. But I think there is a catchment of occupier that are this is more than just a 1 or 2 year fix. This is a 10, 20 year horizonary move.
But a real sea change, you think, in terms of supply chains and where that's heading and what that means, particularly, let's say, for Europe as well.
Yeah, for sure. For sure.
Good. I may come back to that, but I wanted to pick up, because it's all part of also a discussion around resilience, I think. Energy was a topic you brought up there, Renata. And so, Joost, just coming to you, obviously, energy resilience, energy self-sufficiency, a lot of focus on that in general, but specifically, I think, something that is pertinent for the logistics side, given the fact that there are huge roofs with potential. So just from your perspective, what are you seeing in the market? Are you seeing more of a focus on that kind of solution?
What we see in the market is that besides all the difficulties logistics and industry now have, is that also the mandatory of ESG stepping in. And there is a lot of, we call it brownfields. And with the CRREM methodology, all those buildings are going to be stranded. Now, so therefore, and you see the cost of the supply chain is rising. So what we see is a big shift, and we support that shift very much, is that you can use those big logistics, making it a net zero building and give it to the tenant, therefore their cost will lower. They will keep the building longer, there's a higher and longer occupancy rate, and therefore you make a better price. So use the potential of your ESG into something what can be very beneficial.
And how much of an issue is, let's start with you, Christina, just how much of an issue is, let's have, that one is for you two, that one's for you two, and that one's for you two. Christina, let's pick up with you. Pick up that point around energy, but also specifically ESG.
Yeah, so I think the energy point is really important. We have many occupiers in our portfolio who are thinking about, how rents are going up, energy costs are going up. What do we do to counter that? And I think the solar panels, especially, are a good way around that, making the occupiers' costs come down slightly as the rising energy costs come through. So I think that's a big point. Investors these days ask us a lot more questions about ESG than anything else for that matter. So it is absolutely on the forefront of everyone's minds. But what I feel as a fund manager is good to hear is that the occupiers are asking similar questions. And so it's a real teamwork, cooperation effect where occupiers want to work with us when we develop or invest, buy assets, to make these the right fit for them in terms of ESG, and that happens to be the right fit for investors. And importance on either side makes it a lot easier for us in the middle to facilitate that topic. So very, very important, and we have a lot of work to do in our portfolio. We have some older assets that we need to retrofit and improve, and where we build new or buy new, it's obviously, hopefully already there, but this is not a static topic. I think there is not just a GRESB rating that you hit one year and will always hit. You have to work towards that every year and continue to improve, and obviously legislations will change and make it tougher. So it's a very long-term trend, frankly, that I see.
Okay, great. And Peter, it'd be good to just pick up from your perspective as well, how you're seeing that side of things in terms of energy. Occupiers also beginning to look more at, we've heard already today, occupiers across all sectors beginning to look more at the total cost of rent, so including energy within that. And so I guess what's your perspective on that, and also picking up the sort of self-sufficiency and energy side?
Yeah, I think it's a great opportunity for everybody in the market. Like you say, the collaboration that needs to be there between tenants, investors, and all the other stakeholders that are there. We can use the current market circumstances to really improve the buildings, to invest in these buildings, to make them more energy efficient, to create net zero new developments, because the urge is higher than ever. So what we see in almost every situation, there's a willingness from all parties to collaborate in this, to invest and to jointly create these kind of buildings and make them better and create good labels, etc. So it is an opportunity actually.
Okay, good. And Carolis, feel free to pick up on anything in terms of your strategy around that. But I'm also interested to see, looking at global trends, one of those is also capital flows, what's happening in terms of the flows of global capital towards this sector. Have you seen a change in that? Have you seen a pause in that? What's the sense you get of investor appetite for this sector still?
I'll chip in very briefly on ESG and what I think about that, and then I'll try to answer the capital flow question. So ESG, I had a friendly broker drop me an email a year ago saying, Carolis, what's your view on ESG? Do you really care about that? And I said, well, it's something I would mention in a IC book, but really not something I base my investment decision on. And then, 12 months down the line, there are a bunch of Scandi funds who would not even acquire an asset unless it has specific ESG requirements, and then a bunch of other funds are issuing green bonds because of the ESG-friendly assets that they have, including us. And so overnight, ESG from being a marketing trick became something that people really care about. And a lot of buildings that don't have ESG credentials are becoming illiquid, in my view. So I think there has been a very dramatic change for ESG, in my view. And on the capital flows, WP Carey, we are sector agnostic, so we don't chase any asset class, we don't chase any location, we chase yield. We always like logistics. I think there's been a logistics bubble with the pandemic, which has burst now. I think capital still likes the logistics, but capital will flow where they can get a return on the money. And I think at the moment for the prime sector logistics, there's been too much of a disconnect what the seller wants and what the buyer is willing to pay. And until that price discovery happens, I think there will be no liquidity in that sector. And I think that price discovery needs to happen probably within the next 3 to 6 months for anything to start moving again. And I think people or sellers been spoiled by the very hot sort of logistics market during the pandemic, and it takes time for them to get back to reality. And I think that's my view. So the capital flows will have to follow the sentiment.
Yeah, I fully agree with that. Although we see a clear difference between the big box logistics and industrial mid-size to smaller logistics buildings, which are more resilient from a pricing perspective so far. I mean, that it may change, but I mean, cap rates are increasing quite drastically for the big box logistics, and for industrial and mid-size logistics, it's different, and that has, consequences. And it's an interesting aspect as well, because it has proven over time that tenants are more sticky there, more attached to the certain locations, etc., etc. So are different elements to this as well. The price correction that we see, what's happening, but there's a difference. Yeah.
And Nick, go ahead.
Yeah, I was going to say, I mean, this is probably a response from a single sector specialist, but to fight the corner of the logistics market, I mean, I take all those points, and I think they're extremely valid. But in terms of global capital flows, there's certainly still a sense that a huge amount of the capital still buys into the growth prospects of what the industrial sector offers in the medium, perhaps even into the longer term. And I think for the first time in quite a long time, as Carolis was mentioning, there really was, going back over the past few years, the capital markets were ahead of the occupational market, whereas for the first time now, it's sensing the occupational market is ahead of the capital markets. And until that price correction that we start to see on whether that be land or stabilized assets to sort of close the delta between the bid and the ask, you're going to see illiquidity in the market. But the occupational fundamentals are still, at the moment, they're supporting a sort of a compelling investment thesis into the sector. It's just that the cost of capital's gone up.
I would just add, if you take the debt and capital crisis out of the equation, if you look at the sector, I'm definitely a lot more bullish towards logistics sector than office sector, 100%. And I think if you look 5 years down the line, when we out of this mess, I think it's definitely a sector that will shine and will be above other sectors. I agree with that for sure.
Okay, good. Did you want to pick that up, Renata? Feel free.
Yeah, what we observe, obviously there's a slowdown, and everybody is looking at the cap rates and comps for the transactions. But overall, the assets which are sustainable in various aspects, they're sustainable on the location, on the function, on the urban logistic, and from the tenants ratings. These assets are still, let's say, stable in terms of the cap rates.
I was interested to pick up you mentioned there, Carolus, about obsolescence. And if we'd have had this conversation about logistics 4 years ago, 5 years ago, people would have said, well, there's not really that much obsolescence because it's just 4 walls and a roof, essentially. So what are we building into that? Is there going to be a real bifurcation in the market between those that do have the ESG credentials and those that don't? What is that already happening in terms of values?
Yes, what we see in the valuation teams in London, yes, absolutely. I think logistics or the good industrial buildings are now a part of our main infrastructure, like hospitals. Without logistics, no goods will be delivered. So they need it, and I think because of the supply chain, it will be tripled, the amount of boxes we needed. But I think really good boxes with a really good ESG in it, absolutely they will have a higher value. Yeah. It cannot be.
And Christina, you want to pick that up? Yeah.
Yeah, I mean, it's always the way that modern buildings are more sought after by occupiers, so they also have an easier lettability. They have more rental growth coming through, so it's pretty no-brainer to say that they're also more sought after for investors. I also think that the topic of ESG and modern buildings versus old is an interesting one in terms of older buildings being retrofitted to be have the modern standards that occupiers need. So I think that is a big topic, and not just developing new, but also redeveloping what's there. And that can also be other asset classes being converted into logistics that we're starting to see, certainly in the UK. So I think those topics all flow together, but I think it's a really interesting investment proposition. And yes, modern will stand before old. I think that's just fact.
And how do we see the developer markets at the moment? Because obviously looking at what's happening with interest rates, financing costs, is that changing the sort of role at the moment of development within this area? And is that therefore going to restrict the types of, restrict product to a certain extent?
I'll quickly comment on that, and Nick's probably got some further views there. But, I guess the finance world is slightly tighter now, and the costs are higher. So I'm sure there'll be some developers that might be priced out because they can't get debt financing. I know that in Germany, developers were able to get pretty much 100% debt on developments. So I think that will probably have stopped by now. And so maybe there is more need for equity coming in for some of those players, or they might have to sell off some sites. And so there'll be some interesting opportunities coming out of that, as ever with markets when pricing changes or the financing background changes. So I think there's an opportunity. Will that mean that there's no new developments coming through? No, because obviously there is plenty of equity out there wanting to fund logistics developments in particular. So I think it's still a really great opportunity.
Nick, you want to pick it up?
To be honest, I would echo exactly what Christina's been saying, and to add, I think the other issue that we face as a developer is getting hold of correctly priced land, and land just doesn't adjust at the same rate that the stabilised asset market seems to adjust. There's less institutional ownership, there's no debt secured against the land, so we're unlikely to see sort of refinancing issues and disposals on the back of that coming around next year. So it's very patchy, and some you've got to just try to identify those sites where the motive of the seller is there to adjust, and because at the moment the land price is really the only lever left to pull. You've got cap rate decompression. Rents are still moving up, but we're probably going to be less bullish about the ongoing forecast of how much that compound rental growth is going to be. And then the other big one is obviously build costs. Now we've started to see some stabilisation in those build costs, which is a welcome relief. And I think there are some spikes that will come through on certain elements within that cost stack, whether that be steel or concrete. But at the moment, that's settling, which makes our life a little bit easier. And also now through order books of the GCs starting to thin out a little bit, you can start to benefit from some competitive tender processes, which is also helpful. But yields were so low, any small movement and on the decompression there, you need quite a lot of gains in other areas of that cash flow to make them viable. And I think naturally there will be less development coming through because of that, which will only compound the sort of the imbalance that we have at the moment and the acute shortage of good quality, modern, functional logistics space. But the capital on the equity side is still there. It's just not yet accretive to use the debt, which is slowing things up.
Okay, I wanted to pick up a little bit on what was happening in terms of demand on the occupier side as well. Are we beginning to see different requirements coming through from occupiers? I mean, interesting to note DHL specifying that they don't want to have gas as a form of energy coming into, it's got to be all electric. So, I mean, that's driving an ESG point as well. But just in terms of occupier demand, what are they looking for? Is it for more big box? Is it for higher roofs? Is it for multi-story? What is it that you're seeing in the market, I suppose, in terms of the demand from the occupier side?
I'm happy to go again. Yeah, it's a very good question, and I think if I just sort of bring it to the UK as an example, there's a lot of noise still around London and the last mile, the last touch, etc. But really, when you break down the segments around London into the various catchments, I mean, it's quite amazing when you look at who the occupiers are that are actually taking the space at these extremely high rental levels in comparison to where they were 5 years ago. And it's not e-commerce. E-commerce is pushed out of London. They can't have their vehicle fleets. It's congested. They like to drive in and drive out. Really, it's been quite a broad, which is also the beauty of our sector, is that you can attract a very broad catchment of occupier. The occupier base is quite deep, and it's content creators, it's data. You might have some of the finite last touch, last mile, grocery delivery operators, etc. But really, it's not the e-com. It's not what everyone's been buying into. That's sort of moved out. And where we've seen the real leasing velocity, it's actually been outside of London in the big box, as there are all these drivers to reshore up their supply chains, hold more inventory, and it's more typical logistics.
Okay, good. Renata, come in.
Yeah, I think the question was also about the setting up the standards on the technical features of the buildings. That what we observe from the market, that these are the owner-occupiers who wants build-to-own schemes and who look for the longer period of ownership of the buildings. So, and also they want to meet the zero carbon criteria. So Richard mentioned DHL. They are building in Poland their own buildings, and there are many other companies who wants to set up the higher criteria of the building, where when let's say the development standards is in the middle to meet the, let's say, expectation of investors and other users. And I think that was probably behind your question, right?
Yeah, and I mean, interestingly so DHL developed their own in Poland. Is that because they couldn't find exactly what they were looking for? And there was no, I mean, do you know what led that? If you don't know, then that's fine. But do you know what led to that decision?
I don't want to comment on that, but it happens very often when the owner-occupier wants to build their own building, either via developer or by themselves, but according to their own specification, which is usually higher than the market standard.
Okay, interesting. I think it's interesting also, Joost, just to come to you while we're talking about the occupier side. Obviously, energy is a large cost for the occupier, but there's a bigger focus as well from occupiers in terms of top quality buildings, being high ESG standard. So I suppose, how much of the demand that you're seeing is coming from the investor or owner of the building, the asset manager of the building, and how much is coming from the occupier side?
I think the occupier is more and more leading, but they also know the amount of free space is less, especially in the last mile. But more and more for them, it's also their marketing tool, because they feel a little bit more guilty by transporting and doing all the goods. So therefore, they want loading EV loading points. They want EV vehicles, and on that point of respect, they are really changing, and they see the opportunity on their roof. So they are really demanding in it. Come on, I would like to rent, and the rent is one point, but I need the rest also.
And just on the capital markets side, I suppose, obviously again globally trend rising interest rates. Does that mean that we're going to see lower pricing, or will we just have a pause where there's limited activity? What are you expecting from the investment side?
Well, we clearly see obviously already lower pricing coming in, especially on the big boxes, but also, like I said, on industrial and the total sector, which makes a lot of sense due to the rising interest rates and all other aspects. So, is it temporarily, or we will see, but obviously a lot of this has to do with the rising interest rate environment, and it makes a lot of sense. I mean, cap rates were so low, and now that doesn't, I mean, it has to be corrected, and I think there will be a new stable, and there will still be interesting new transactions coming up at different price levels. So there will be opportunities still, but at different price levels, definitely, yes.
And in terms of strategy, will you be still using leverage in terms of acquisitions, or will you be then preferring to go an all equity route? Are the sellers looking for all equity? What's the situation?
Well, we are personally increasingly looking to buy all equity and to make a portfolio of certain buildings and see next year where we are on the financing markets. And because today it's so extremely volatile. I mean, swap rates over the last 2 days, I think 5-year swap rates in Europe were 40 basis points up and down. So it's really difficult these days. But we expect that to maybe stabilize, and then let's see how we can refinance. But for now, it's all equity.
Yeah, I add to that. I mean, I think that the market is just volatile, full stop at the moment. It's very hard to know where pricing may still go, or has it reached where it needs to go. So I think it's a very uncertain market. But I think that only ever takes a few months, as we talked about. Bid ask will meet, and I think we will go again. So, but yes, I think prices have moved. And yields expanded, and that's the direction. I don't think it'll turn back around anytime quick. I think the financing question is an interesting one. We tend to use fund level financing, which we've raised, or we're lucky to have raised. So we can still do that. That's relatively accretive. But senior debt outside for asset by asset is relatively expensive. But I think in some markets still accretive. So I really think it's the equation of does it make your return look better, and how do you finance yourself? But it's a tougher market. But again, I think even the debt market in terms of logistics is better than other sectors. So lenders still open. It's just more expensive.
Okay, good. And Carolus, in terms of the discussion around sort of big box or more urban logistics, what are you seeing there as some of the trends? Obviously, we know that there was more of a dip in terms of e-commerce, which you would expect post-pandemic. But obviously there are different markets. UK quite high saturation, obviously, but less so in other areas. So I suppose, what are you seeing as the opportunities there across Europe? What are you seeing?
It's a tough question. I think it really depends on the market. For example, the Polish market, there's still so much more room to increase the last mile logistics. And I think there's definitely room to grow and opportunities to make money there. Like you say, UK is more saturated. It really depends on the market. But maybe I can twist your question, and if you ask me where I think the deals will come from, and maybe not necessarily logistics, but I think logistics are part of it. I think it all will be driven by either PE acquired portfolio companies that were funded by short-term debt and will need to be refinanced. And they will probably do sale leasebacks on the real estate of the portfolio companies, including the logistics assets. maybe wishful thinking, but I really see that coming to market. I also expect a lot of owner occupiers who operate their own logistics centers, who will need to refinance the debt, to also consider doing sale leaseback on the real estate they have, and probably logistics will be the most attractive real estate that they can get most value out of the stuff that they own. So I think the deals will come from that area as well. In terms of, like you say, big box, last mile has always been priced somewhat tighter than the big box, but I wouldn't like to say that one is more attractive than the other today. To say where the market will be a couple years in the future, no one really has the crystal ball. If anyone tells you that they know, I think they're lying, because nobody knows. But I definitely see the trend, for more optimization of the supply chain. And what I said earlier, I think the last mile definitely will be more attractive to a bunch of investors.
Okay, good. And do we think that in general investors are going to be retreating to core, so the best of the best in the best locations? But obviously there, the yields were smaller to begin with, so if it moves out by 2 basis points, that's maybe more of a problem than one that was starting at 6 and is moving to 8. So I don't know, what's the sense of that? Do you think people will then look more at the core best, that it's going to be about resilience and therefore the best assets?
I mean, in uncertain market, the more institutional capital will probably focus on the more core locations, modern buildings, etc. But I don't think that's exclusive. So I think different risk profiles will look for different return and hence focus on different asset types. So I think yes, there is secondary product that maybe people will not touch for some time, but I think that will come back round if it's at the right price. There will be a buyer for that as well. I think it will move out in different ways depending on how core or how prime you are. But I think there will be enough capital to be interested in both sides of the equation.
Okay, good. Yeah.
Yeah, and I actually think it's a very interesting question, because I think the logistics landscape over the past decade has evolved massively, and a lot of that's driven by the e-commerce factor playing into it. And what we've seen is occupiers are a lot more footloose in terms of where their locational decision making is. And if you look back 10 years ago, what traditionally was always seen as the legacy industrial locations, very established, I mean, that hasn't changed, but there are a number of other fundamental factors that come into their decision making, which are all well known about, power, access to labor, access to the consumer, and all of that. And I think that landscape hasn't changed. So if you're trying to look back and at what was always traditional and what's a core location, I think we've seen the emergence of new markets around Europe, and you can see it in the leveling out with rents. And it's driven also by a shortage of stock, but there's been a balancing effect. It's not so heavily weighted to some of these major epicenters of which have always historically been the heritage for logistics. But these new markets are almost just as liquid from an occupational perspective, and occupiers are therefore willing to pay the same sort of rental level. And I think that's where some of the most interesting opportunities have been over the past few years, is actually buying into these new emerging sub-markets, which are still extremely sound investment propositions.
Okay. I might add one point to this conversation, that what we are observing now is that institutional money is just take the position of wait and see for the new comps, when the market of the investors who were present in the past and for the last 5 years, they were pretty silent because of the competition in this sector. They couldn't reach the product. They are very active. They are coming back and seeing the opportunity with the, let's say, not the best product, not the core product, but maybe secondary and regional markets. So I believe there are different type of product for different type of investors, and especially in these days where the appetite is very selective and very cautious, this situation that the gap between the best product and the secondary product will be larger and larger.
Okay, good. Did you want to pick that up?
No, I mean, it's a very interesting aspect, because we see a lot less competition already for these locations, while we are of the opinion that if you still continue that road, those locations have proven to become very resilient locations as well. We can buy them at different price levels today because of the institutional parties that are on pause. So it's also an opportunity these days to go into the market and keep on looking into those locations.
Okay, good. We're coming up against the end of the time, but does anybody have a question that they want to ask? If so, now is the time to do that, and I shall scan the room for approximately as long as it takes me to do this sentence. Very good. So I guess what I'd like to just pick up on as a kind of final thought, we're looking at trends, outlook and opportunities. So I suppose, where do you see the opportunities? Because if you've been at events for the last 2 weeks, a lot of them have been quite miserable. So let's start looking at some of the opportunities. So let's start with you, Renata, and we'll move down towards Nick. Renata.
I mean, logistics has their own fundamentals. We all need to eat and consume. So it's the sector which has the fundamentals. So the only thing is just we need to understand what are the right prices, and sustainable product will always have clients. And I believe CEE is probably in these circumstances is more opportunistic within the next year.
Great, Carolus.
I think in my view, the decrease in prices, increase in yields is not the reflection of sector underperforming, it's a reflection of the capital markets and the cost of money increasing. So it should not be considered as that sector is less attractive. I think that the sector is more and more and will become more attractive in the future. It's just the cost of funds, reflecting it in the price. So I think opportunities will be to find the jewels, find the right tenants, find the right locations where you can make your cost of money work in those areas. And it will be driven, I think, a little bit random and a little bit by the market forces.
Okay, perfect. Christina.
Yeah, I agree with the sector comment. I think that the issues we're seeing are not related to the sector. And that's why I'm excited, because I think there will be some market opportunities that will present themselves that we just haven't seen over the last 2, 3, even longer years. And so, we'll be able to have some conversations again about an asset rather than having to bid amongst other 25 people within 2 days. So I think, the market is good if you're an investor and you have equity. And it's also about buying or investing in the right long-term asset at a reasonable or sensible price. That's obviously a subjective statement, but I think it's nice to be able to buy those assets that we believe in long term, and those are not overpriced anymore as there have been in the past.
Yes, obviously I also agree to the sector perspective very much, and we think this is an opportunity, this window, to especially look into the repositioning of older buildings towards more ESG-proof buildings, to benefit from less competition in secondary locations, to buy shorter leases to capture rental growth. So there are opportunities, and that will remain in this sector, yes.
Good, yes.
Out of the box, I think there is a great opportunity growing. If you see it in my old days in the derivative markets, is starting a fund, buying up all the brownfields, demolish them and replace very, very good last mile high-end ESG buildings with free electricity, net zero, and rent them out for a long term. That would be a very interesting thing.
Okay, good. I look forward to see you raising that fund, Joost. Nick.
Yeah. Probably another bit of a plug towards what we obviously specialise in, but I think that the fundamentals supporting a development strategy is still exceptionally sound. I mean, there is obviously, as we've discussed, this dislocation between the capital markets and the occupational markets, but the fact that the occupational markets are so sound, I really think if you're able to access land, which is the hardest challenge now, at the right price, and being able to deliver modern functional logistics to really capture that really tangible demand out there at the moment, I genuinely think that still remains a very compelling opportunity, the development side.
Great, really interesting to pick up on some of those trends, how they're playing into the investment side. Thanks very much to everybody for joining us. Thank you for joining us online. If you're watching it on demand, thank you for watching.